can hear me. And warm welcome to this press conference on behalf of the International Monetary Fund. I'm Jerry Rice of the IMF, the Communications Department here, and this is going to be a press briefing on the Euro area Article IV Consultation, which is just concluding. And I'm very pleased to tell you that we have with us this morning the managing director of the IMF, Kristalina Georgieva, who will be joining us momentarily. And we also have with us our director of the European Department here at the IMF, and that's Alfred Kammer. Hello, Alfred. Thank you for joining us. So I believe that the Article 4 staff concluding statement has been shared with you. I hope you were all able to access that. And we will also share with you after this meeting the transcript of this press briefing. I see a number of colleagues from the media online. It's great to see you all. Thank you for joining us today. We'll try to get to your questions. Thanks to those of you who have sent questions in advance, and I will begin the press briefing with some of those since you took the time and care to send those in advance. Thank you for that. The first order of business, however, will be to hear from the managing director, and I believe she will be joining us momentarily. Maybe just a slight technical hitch with the WebEx, so please just bear with us. And as soon as she joins us, she'll make some opening remarks, and then we'll turn to your questions. So we will extend the time a bit, given this technical hitch a little bit at the beginning. So just stay tuned, please. And again, thank you for joining us today. Kristalina had a little bit of a technical difficulty joining us, so she's going to be joining us any minute now. She has joined us. Hello, Kristalina. Hello, Kristalina. You are muted for us, Kristalina.
I think not anymore.
Perfect.
We had some difficulty here. I kept being sent to the Eurogroup meeting room over and over. It is a very interesting meeting, but I think it is time to shift gear and come here.
Thank you, Kristalina. We've already done the preliminaries here, so everyone is ready. If you're ready, Kristalina, then we could just begin with your opening remarks.
Okay. Are we now, can you hear me? So we have gone through a couple of roundabouts in the efforts to come to this meeting. I apologize to all the journalists who are on the call for that. We have a chance to present to you the so I apologize. There is some echo in the line. Could we check whether there are still microphones that are not muted? Can we start now, Jerry? Okay, thank you. And again, my apologies to the members of the press. This is how it is in our virtual reality. Our task today is to share with you the assessment of the economic outlook of the euro area, together with our policy advice. I just came out of the Eurogroup meeting where we had a very good discussion, and one in which we broadly found ourselves to be in agreement, both in terms of the analysis of where we are and the degree of uncertainty we face, and in terms of policy recommendations. So first, what I shared is the IMF assessment of the economic impact of the pandemic and the measures Eurogroup policymakers have taken to combat a tremendous negative hit on their economies. We see now a beginning of a recovery, the green shoots of recovery. They came in the third quarter after a very sharp contraction in the first half of the year. But economic activity still remains well below pre-crisis levels. And as you all are very well aware, a new wave of infections is affecting negatively the momentum of this recovery. And what we see is headline inflation descending into negative territory. This is first time since 2016. In this environment, there are two pieces of good news. One is the swift response of policymakers in Europe and their ability to mobilize for collective action. The new Generation EU Fund is a very bright example. And two, the fact that vaccines are on the horizon. We are not there yet, but this is finally light in the end of a very long tunnel. In that context, the policy issues we have focused on with our ministers of the Eurozone are three. First, fiscal and monetary policy. Second, financial sector. Third, structural reforms. On the fiscal policy side, we recognize how much has been done already, but we caution of an expectation that the job may be now behind us. We are urging governments not to withdraw fiscal support prematurely, and we very strongly support the new Next Generation EU fund, as well as progress that has been made on the EU budget. Of course, those tools would work only if they are implemented properly, and proper implementation, especially for the the Next Generation EU fund, means three things. One, high quality projects. Two, not to substitute domestic financing with funding coming from the recovery fund, but to complement it. And three, very importantly, to make sure that the funding is an incentive for reforms rather than a substitute for them. And of course, for many of you who have been following up discussions around a more permanent capacity in the EU, if this fund works well, this is a topic that would come back on the agenda, something the fund has been recommending for. We are cautious that while there is some positive news on the outlook related to vaccines, there is also a great degree of uncertainty. And in that environment, there could be a downside scenario for which augmentation of existing EU-level support may be necessary. Turning to monetary policy, you have all witnessed how decisively ECB stepped up. Both actions, justifiably so, have been essential to put the floor under the Eurozone economy. We support the ECB Governing Council commitment to recalibrate its policy instruments at its December meeting. And if downside risks materialize, of course we pray they don't, but if they do, the ECB would need to further ramp up support via existing and possibly new policy instruments. The strategy review that has been undertaken could have not been coming more timely. Why? Because we do expect on the other side of this crisis to see a very substantial transformation in the economy. And in that context, the monetary policy framework also needs to change. And formally codifying the ECB Governing Council's recent emphasis on the symmetry of the inflation target aim around a specific point target would have significant benefits. Moving to the financial sector, recent measures have supported credit growth and prevented widespread insolvencies. Good news, but unwinding them would require a careful balancing act. It is always easier to put support measures in place than it is to withdraw them. In that sense, banks refraining from paying dividends and other supportive financial sector measures should be maintained until we see the recovery well underway. And if it stalls, a more targeted borrower support should be kept available. Banks remain resilient. This is one of the benefits of action after the global financial crisis. But the depth of this crisis, the severity of the shock means that a significant deterioration in asset quality could constrain lending capacity, requiring a gradual rebuilding of capital and liquidity buffers. And one thing that I want to stress very strongly is that now is a good moment to advance financial sector architecture reforms, close gaps in the crisis management framework. Especially important to make progress in completing the banking union. Many of you have been following up on this issue. You know how important it is to be done. Finalize the European Stability Mechanism treaty reform, and enhance the powers of the Single Resolution Board, as well as advance the Capital Market Union. So get this job done now is what we very strongly recommend. And let me finish with structural policies. There, the tricky part is how to strike the right balance between supporting firms and facilitating structural transformation. The unprecedented scale and persistence of the crisis argues for carefully expanding solvency support for firms. But once the recovery is underway, policies will need to shift towards supporting firms for the post-pandemic era, while facilitating the exit of unviable companies. So we want to see green, we want to see digital, and we want to do support in a way that is primarily focused on workers, and in particular on the young people stepping into the labor force. From job retention schemes, they have been great for the Eurozone up to now. There has to be a transition to measures to help unemployed workers to find jobs in expanding firms. And one thing that our team zeroes on strongly is a fundamental rethink of labor market policies to adapt them to what the world is going to look like in structural terms on the other side of this crisis. One thing that we know from experience in pandemics is that after a pandemic, inequality goes up. That has to be front and center for policy makers, not to allow to happen, neither in territorial terms nor within segments of society. And in that respect, Europe has made progress on gender equality, not to lose this progress as we are now wrestling with this crisis. Let me complete by saying very simply that what has been done is unprecedented. The scale and the speed of support and the fact that it has been done in a coordinated manner deserves praise, but we need to recognize that there is plenty still to do, and especially to do for the future competitiveness and vibrancy of Eurozone economies. Thank you very much, and thank you for your patience. Again, my apology for getting close between the virtual rooms in over there in Brussels.
Thank you very much, Kristalina. That was loud and clear. And I think we're all set now to take the questions. I want to begin with a couple of questions that came in online already. The first one is from Maria Vasiliou Hania in Athens. And she is asking this question. You just joined a meeting of the Euro area finance ministers. What was your message, especially to countries with high debt, both in terms of sovereign debt, but also in the form of bad loans, while at the same time, they need to keep spending to support their economies? Kristalina, you are muted for us.
Thanks, Jerry, and many thanks to Maria for your question. My main message was that in unprecedented crisis, the Eurozone has acted swiftly and decisively, way beyond expectations we had in the very early days of the crisis. And as a result, we have avoided a collapse of the economy, massive bankruptcies, and massive unemployment. The recovery looks promising because of measures that are taken, and because we have an expectation for vaccines to boost the outlook. But we're still in a high degree of uncertainty, and we are in a place where still the motto has to be pray for the best, prepare for the worst. And that, in the case of the Eurozone, clearly is related to how to handle this loss of momentum in the recovery that the new surge of infections has brought. You're right to be concerned about countries that have high debt levels. Everybody is seeing increase of debt, but for countries that stepped into the crisis already under a heavier burden of debt, the situation is particularly difficult. There are three factors that are easing this burden and can be deployed even more. First, the accommodative policies of the European Central Bank, and as I mentioned in my opening, ECB, if needed, can do more. Second, the impressive stepping up of collective action, the solidarity Europe is bringing with 1.8 trillion recovery package, the combination of the EU budget for the next 7 years and the new generation EU fund, which rightly consists not only of grants and loans, and rightly aims to not only soften the impact of the crisis, but most importantly, to boost growth prospects. Because we know that countries under debt are in much better place in medium term to consolidate this debt if they grow more, if they enjoy robust growth. And last but not least, there are elements in the financial support for countries that are there, not yet tapped into, like the European Stability Mechanism precautionary credit lines. They're there, have not been used. Obviously, this is yet another buffer for these countries. Ultimately, that 2021 is going to be a transformative year. And the question is, transformative to what? Hopefully it would be to greener, digital, and fair economy in the European Union and in the Eurozone.
Thank you very much, Kristalina. I want to take a question from Jan Strupazowski, and I think Jan is on the call, but has asked us just to go ahead and read out his question, which came in just before the briefing. So Jan is asking, given COVID-19's pandemic effects on the Eurozone economy so far, what main policy challenges does the IMF see for the Eurozone in 2021 and beyond? And Jan is also asking, as the number of NPLs, non-performing loans, is likely to rise as a result of the pandemic, is there a rising likelihood of a financial banking economic crisis in the foreseeable future? And just to say, this question around NPL seems to be one that a number of people are asking. I see AFP, Delphine asking around that issue, but let's just focus on this question from Jan. Thank you, Managing Director.
But the most pressing issue countries will face is to move in the near term, is to shift from lifelines to policies that support the recovery. Quite rightly, in the very first months of the crisis, support was provided to everyone, to firms that are doing well and those that may be doing more poorly, to those with good prospects and those with less clear prospects. From moving from those lifelines to more targeted support is going to be a very important responsibility of policymakers. And as you can imagine, they will be faced with lots of pressures and lobbying, and they need to zero very clearly on the policy objective of coming from this crisis more competitive with more vibrant economies. So how this transition would be done, given that it has been successful, the retention, for example, the retention schemes, they have been successful to prevent a collapse of employment. How to move from those schemes gradually to job transition would require a determined and well-informed action. And as I mentioned in my opening, how is this done? With very careful attention to prevent increase of inequalities. We know that after the global financial crisis, the positive was strong, resilient banking sector. But on the other side, we have seen in many countries an increase in inequality. And most importantly, increase of inequality of opportunities. Now is the time for resilience to be built in Europe with more concentration on resilience of people. They're educated, they're healthy, there is sound and vibrant social protection for them, resilience of our planet, taking climate action, on top of resilient financial systems. Obviously, you're right to ask what we do see concerns about non-performing loans going up. When you have that, first thing first, there has to be a comprehensive strategy to tackle bad loans. And that includes credible NPL reduction plans, strengthening insolvency regimes. They're better in some places than in others. Out-of-court debt restructuring. And national asset management companies, they can help deepen distressed debt markets, especially if they're linked in a network. And that was one of the recommendations we have made during today's meeting. Thanks, Jerry. Back to you.
Thank you again, Kristalina. I'm going to go to El País, and it's Luis Pellicer, who is in Brussels. And Luis is asking a fairly straightforward question. Is the current EU recovery instrument of 750 billion euros enough? Is it enough? Or will new fiscal measures be needed next year to underpin the way out of the crisis?
Oops, sorry. Can you hear me now? Okay. Let's remember that the 750 billion is part of a bigger package. We need to also remember the 1.1 billion for the 7-year EU budget that would also be deployed to support the recovery. 750 billion is quite significant. It would be, I would concentrate actually most on the quality of how this money is being used. And I said in the opening, if the money is used for high quality investments that help you transition to low carbon, climate resilient, digital economy of the future, if they're used to boost research capabilities and the role research plays in competitiveness of Europe, if they don't substitute for domestic financing but add to it, and above all, if they are coupled with commitment to reforms, this can be truly transformative. And of course, before anything else, all the still existing ripples need to be sorted out so a deployment can happen fast enough. The quality of the plans with which countries approach this money is going to be absolutely essential. It is a chance to make a difference. And I think if we are to stay optimistic, we can also see out of this 750 billion to grow a new way in which fiscal capacity at the collective level is being established, something that has been long on the agenda, will only happen if we do a good job this time around with the 750.
Thank you very much, Kristalina, and thanks to Luis. I can see Luis with us there. I'm going to try and take a couple of questions on WebEx. Let's hope the technology helps us. I'm looking for Paul Hannon of the Wall Street Journal. Paul, are you there? And would you like to ask your question?
I hope I'm visible to you or audible to you. Great. Okay. Just reading through the Article 4, and I was wondering what exactly you think a severe downside scenario would look like. And there's a reference in there to the augmentation of defenses in the context of fiscal policy. So I was wondering if that was in addition to the ESM credit lines that you mentioned. Are we possibly going back to the kinds of funding packages that we saw in the crisis? And in a related question on the ECB, there's a mention of the possibility that, if the banking channel did get blocked, that the ECB should consider providing direct support. I'm just wondering how an institution like that would reach, the companies that really count at the moment, which tend to be smaller and medium-sized enterprises that are, having the biggest difficulty keeping going in the hospitality sector. Okay, thanks.
The downside scenario that can be quite dramatic would be no durable exit from the health crisis in 2021. If vaccines, for some reason, don't deliver, and we are faced with a third wave of infections, that is going to be very difficult everywhere, including in the Eurozone. Now, let me say that we have confidence in the news on vaccines, and in fact, Paul, our baseline scenario from the October World Economic Outlook, in which we expect 5.2% growth in the Eurozone, was based on vaccines available by mid-21, and for the world, vaccines deployed everywhere by end of 22. and there is very good chance that this would materialize, may even materialize a little faster in some places. But if it doesn't, because it hasn't happened yet, and we cannot afford the luxury of assuming it would work perfectly once vaccines become available. If it doesn't happen, then we may be faced with the situation in which more needs to be done. And this is the good news about Europe. Europe does have lots of buffers. You mentioned the precautionary credit lines, not tapped, they're there. The ECB has been really very prudent in making sure there is ample liquidity at very low cost, so governments can finance themselves. And for sure, if there is a pressing point for more creativity around how to support the economy, that will come into place. As for the ECB, one of the points that our team brought in the discussion was, should conditions become worse, a more direct support for non-financial institutions. And obviously this needs to be worked out. And in fact, Alfred, do you want to add to this point? Or we are covered? Alfred is our director. Alfred Kammer is our director for the European Department.
Online now. Maybe just to add, if the financial transmission channels are affected in a severe downside scenario, we wanted to stress that there are other instruments available. And not just ECB, but it could be other European institutions creating a special purpose vehicle which could directly lend to viable enterprises. We were thinking something along the line like the US Main Street lending program. But of course, we would need to make sure under these circumstances is that there are safeguards in place and so that the lending goes to viable enterprises. So that was the idea, severe downstream scenario, downside scenario, more instruments available if needed.
Thank you very much, Alfred and Kristalina. I just want to note, I see that Martin Arnold of the FT also had a very similar question about the ECB and direct support to non-financial corporates. So I think we've covered that, and so I won't come back to Martin on that one. But I do see Jorge Valero, Euractiv, is with us. Jorge, would you like to come in? I know you have a question or a couple of questions about Spain. Jorge, would you like to join us live?
Yes.
Thank you.
Yes, I hope good afternoon, Managing Director. I hope you can hear me well. First of all, I'll follow up on the possibility of a second European stimulus, because so far the message here in Europe is that they want to focus on implementation of the first package. So I would like to know what was your reaction when you gave this message to the Eurozone ministers, finance ministers. And secondly, I wanted to ask you about Italy and Spain, whether you are concerned about the sustainability of their public debt, given that they are two of the countries with the highest public debt, and they are also the two countries more hard hit by the pandemic. Mm-hmm. Thank you.
Thank you, and great to see you, Jorge. Are you in Brussels? Do we find you in Brussels?
Yes, I'm in Brussels.
Say hi to Brussels for me. Look, you're right that the first priority for the European Union is put the 750 billion to work. And before even that is done, the remaining hurdles around the package that you're very aware, very familiar with, the EU budget, the Next Generation EU Recovery Fund, and some of the requirements from member states, that this is fully and entirely in place. And we do agree that focusing on the 750 billion, making sure that there are good plans, recovery plans, that countries come up with strong focus on recovery that is also transformative and that addresses the structural issues I mentioned in my opening remarks, that these plans are in place and that implementation capacity is strong, because only then countries will see the benefits of growth that ultimately would take them out of the legacy of this crisis. There will be scarring, and it can only be addressed if we are honest about what are the impacts on which sectors, which segments of our society, and how these impacts can be best mitigated. Italy and Spain, you're right, they came into the crisis with high level of debt. In the case of Spain, it has gone up now. It is headed to 120% to GDP, and Italy is also wrestling with a big debt pressure. But this is happening at the time of record low interest rates. And it is happening at the time when, because of the stimulus that is going to be directed to lift up growth in the economies, there is a chance for these countries to get on a different growth trajectory. And I would really, our advice to policymakers is take this chance to move to a more dynamic, competitive place. And I have no intention to pretend this is going to be simple and easy. But it is a moment in which this capacity to borrow cheaply, to retain a level of debt, high level of debt with less burden on the budget, and to have grants, in combination of grants and very concessional loans deployed for a green public investment, can bring economies up to a higher growth path. We actually are very pleased Europe is doing it together, because what we calculated is that a green investment push, if done together, if countries do that together, brings much higher growth benefits. The acceleration is, the multiplier is higher as a result, and this is what Europe is doing. Now, obviously, I wouldn't be the IMF if I don't say there would be this time when that sustainability has to be main focus of attention, but it is not right now. We are not yet in a place where we can look at this health crisis in the rearview mirror. Only then we can zero on how we bring that sustainability, how we deal with budgets, and the best strategy, of course, is if we can write on more dynamic economies and higher growth rates.
Thank you, Kristalina. I think we're running out of time, but since we did have that technical hitch at the beginning, I just want to offer the opportunity to anyone who might have a last question, if Alfred and Kristalina have time to stay a few more minutes. If you would like just to signal to me, I see Maria, I see Kemi, I'm only seeing producer, but please go ahead and identify yourself, Madame Producer, and you will have the last question to Kristalina and Alfred. Thank you.
Okay, thank you. This is Effi Koutsakosta from Euronews. Hello. So I want to have a follow-up on the question on debt, because also it's, of course, Spain, it's Italy, it's also Greece. There are countries that, of course, have many structural problems. They have them in advance before. So what do you see is happening with this debt accumulated? who is going to pay the bill? And if there was, a suggestion by Italy, unofficially, of course, for a delete of the pandemic debt, of course, I would like to ask you if this is a proposal that should be on the table, given, of course, the exceptional times that we live in.
The problem countries face with that is multi-layered. There is the government liabilities, governments borrowing. There are companies with high level of debt, and there are consumers that may be faced with higher level of debt. So what we're seeing is in all three dimensions, this crisis has created more pressures, but especially on governments. Why? Because we asked for something that has never been asked before, for producers not to produce and for consumers not to consume. Obviously, putting a floor under the economy does require governments to step up with fiscal measures, and it does require the European central banks and, in the case of the rest of Europe, national central banks to come up with highly accommodative policies. Now, debts don't disappear. Even when they are very low cost, even when service is at exceptionally low rates, there's something that has to be dealt with, and preferably dealt with in a prudent manner rather than we kick the can down on the next generation. And the way to do that is always best on the basis of growth that allows incomes to go up, national income, companies and individuals, so they can have a higher debt servicing capacity. And this is why we so much welcome the Next Generation EU, the decisiveness to inject more capacity to reinvigorate growth in Eurozone and in Europe. Now, of course, easy to say and much harder to do. But imagine what it would be if Europe very decisively invests in the knowledge economy, in the digital economy, and in the green economy. That generates jobs, well-paying jobs, and it generates growth that is a double win for the next generations. It prevents the next big crisis from hitting, the climate crisis, and it generates capacity to serve debt. I saw the comment made in Italy about ECB coming up with debt forgiveness. This is not in the mandate of ECB, and it would require EU treaty change. So, are you based in Brussels? Where are you based? Brussels. I leave it to you to judge how easy it is to do. So you're very familiar with the complexity of this topic. But beyond that, at this point of time, ECB is doing the right thing, which is make the capacity to borrow highly affordable to everyone, to Italy, to Greece, to Spain, to Portugal, to everyone. And we have seen governments being able to do that at a very low cost. So I think the concentration in the EU ought to be on competitiveness, productivity. I mean, Jerry, if you allow me, just to make a slight diversion and go to 2019, the pre-crisis year. In this year, I started in October as the incoming managing director of the IMF. What did I talk about in my first speech? I talked about synchronized slowdown, low productivity, anemic growth, growing inequalities, and a looming climate crisis. None of this has gone away. Now we have a chance to use the resource we are injecting in our economies to address these problems that we had before. And kind of shame on us if we don't do it. And then we can serve that, then we can get on a sound financial footing.
Kristalina, thank you very much. I think that's a really good place to end. Unless, Alfred, you had a last word you wanted to offer? Alfred, anything from you?
Really nothing to add. I think that was a very comprehensive briefing with very clear messages. Thank you.
Thank you, Alfred. And thank you, Kristalina.
Thank you. And again, Jerry, I want to profoundly apologize for this confusion of being in the wrong room, trying to get out of it, and then being shipped back into this room. Then finally, I managed to get on my iPad in your room. And as I did it, somebody threw me on my laptop into the same room, and then we got a big commotion. So I'm so sorry for all this, and thank you for your patience.
Good. I think it's worked out very well at the end of the day. Thanks to all colleagues on this call, the very many colleagues on this call. Thank you, Kristalina, for your forbearance and making the extra time for this press briefing to have adequate time for questions. Thanks to Alfred, our Director of the European Department. We look forward to seeing you all soon. Until then, please all stay safe and stay well.
Yes, stay well. Thank you. Bye, everybody.